Hi CS students, let's revise CA Final AFM Chapter 5 Security Valuation. Practical question 18. Rahul Limited has surplus cash of 100 lakhs and wants to distribute 27% of it to the shareholders. The company decides to buy back shares. The finance manager of the company estimates that its share price after repurchase is likely to be 10% above the buyback price if the buyback route is taken. Now we can see the company wants to distribute 27% of the surplus cash to the shareholders. So when the company buybacks the shares, then they will pay the shareholders in cash. In that way they can distribute the surplus cash to the shareholders. The number of shares outstanding at present is 10 lakh and current EPS is 3. Now we are required to determine the price at which the shares can be repurchased. If the market capitalization of the company should be 210 lakhs after buyback. So market capitalization is nothing but total market value of outstanding shares. So after buyback the number of shares will reduce. So the market capitalization is given as 210, which is nothing but number of shares outstanding into the price. Now we have two hints here. The finance manager estimates that its share price after repurchase is likely to be 10% above the buyback price. So anyway we need to find out buyback price. So buyback price into 110% into the number of shares outstanding after buyback will be equivalent to 210 lakhs. So the same has been plotted here. The price after buyback is our 210 lakhs equal to the buyback price multiplied by the current original shares minus shares bought back. So which will give us number of shares outstanding after buyback. Now as we know it is 110% of the buyback price. So 210 equal to 110 into P. So 110 divided by 100. 110 divided by 100 into P multiplied by the current original shares outstanding is 10 lakhs minus 27 lakh divided by P. Why this 27 lakh divided by P? Since company wants to distribute 27%, so the distributed cash divided by buyback price will give us number of shares bought back, right? So 100 lakhs out of the 27% is 27 lakhs divided by the buyback price will give us number of shares bought back. So original shares minus number of shares bought back will give us number of shares outstanding after buyback multiplied by the buyback price into 110% will give us the share price, which is equivalent to 210 lakhs after buyback. So applying in this formula we are getting buyback prices 21.79 rupees per share. So that's what is the requirement also. The price at which the shares can be repurchased, which is nothing but the buyback price. So first requirement is sorted. Now going to the second requirement, the number of shares that can be repurchased, which is so simple. Since we know that 27% is distributed, so 27% is 100 lakhs, 27 lakhs. 27 lakh divided by the buyback price will give us the number of shares. So 1,23,019 shares bought back. The third requirement is the impact of share repurchase on the EPS. Assuming that net income is same, they have given EPS is 3. So the current net income is 10 lakh outstanding multiplied by 3 EPS will give us the current income, which is nothing but 30 lakhs, and we need the number of outstanding shares after buyback, which will be 10 lakh minus the shares bought back, which is 1,23,910, which will give us 8,76,090 shares. So 30 lakhs net income divided by 8,76,90 will give us 3.43, which will be the EPS. So after buyback, the EPS of Rahul Limited has increased to 3.43 from 3. Thank you.